Okay. Um, Hello and welcome, everyone. My name is Lutfey Siddiqi, and I'm a visiting professor in practice at LSE Ideas and an advisory board member at LSE Systemic Risk Center. I'm also an adjunct professor at the National University of Singapore, having been a part-time member of the faculty at the Risk Management Institute from its inception over 13 years ago, and part of that time was concurrent with my role in investment banking. On behalf of both of these amazing places, I'm delighted to host today's wonderful and distinguished set of panelists. With still just over a month to go to the year, this year characterized by the tragic pandemic and its economic fallout, has been a crucible for risk managers in the financial services industry. Every dimension of risk, market risk, credit risk, operational risk, culture, conduct, cyber risks that we may not have labels for, plans for risk resilience, risk management have all been tested this year. So let's take stock of some of the lessons learned. Are we framing and approaching risk in the right manner? What has worked and what has not in the year 2020? What are the practical challenges that in the practitioner world they face when the rubber hits the road, and what can academia help with? So these are the questions that we would like to address, and I will introduce each of the panelists just before I invite them to make their opening remarks. But before that, some housekeeping points. This session is being recorded. In fact, we're streaming it live on YouTube right now, and the recording will likely be made available afterwards. For Twitter users, the hashtag is LSE Risk SRC. Most importantly, we'd like to make this as interactive as possible. As you know, we have 90 minutes altogether. The plan is that after opening remarks from each one of the panelists, they'll take up to 10 minutes each. I will ask one follow-up question to each of the panelists, and after that, it's all you, the questions from the audience. So please use the Q&A function on Zoom to post your questions, the Q&A function or the chat function. That'll be the primary mode of interaction. For those on YouTube, you can leave your questions in the comment section, and we'll try and get to those, but the priority will go to the Zoom attendees. When you're asking questions, please state your name and your affiliation, maybe where you're joining us from, and please keep the questions brief. As you can imagine, I'll be scrolling up and down in real time, so the shorter and punchier the questions, the better. So let's now get started. First up, I'd like to invite Sneha Sanghvi. Sneha is Head of Financial Markets Asia at Westpac Banking Corporation, based in Singapore with a team of specialists in Singapore, Hong Kong, Shanghai, and Mumbai. Her responsibilities include trading, sales, and structuring across fixed income, foreign exchange, credit, and commodities. And prior to that, she has worked in senior roles in Unilever and Morgan Stanley. And I was just saying to Sneha just now that I'm reminded of the occasional 2 a.m. start to the dealing room in Singapore on a Monday morning, especially if there's been a major announcement over the weekend from the West. So that's what I'm thinking of when I think of the dealing room over there. But anyway, Sneha, welcome, and your opening remarks, please.
Thanks, Lutfey, and hi, everyone. It's great to be here, and thanks for inviting me on this panel. At the risk of giving away my age, I will confess to having seen quite a few market crashes during my career in the financial markets. I started with the Asian financial crisis and lived through the SARS period in 2003, the GFC in 2008, and now the 2020 crisis. So, as we can all attest to, every crisis is different, and we always learn valuable risk management lessons from each one. And even when we think we've learned it all, we get taught another lesson, yet another lesson about the markets. But I'll try and give a flavor to the people in the audience for what it's been like in the dealing rooms as this crisis unfolded. So as you all know, the coronavirus crisis developed in China first and then spread to other parts of Asia. We're based in Singapore, and I have to say that we were all very surprised that people in the rest of the world were not taking it seriously enough. I recall conversations in early February when people were still seeing it as some kind of a flu. So I think that being in Asia, Lutfey, to your point around being disadvantaged with a 2 a.m. start, this time around, I must say that we did have the benefit of the proximity to China. We did have a slight advantage to be slightly better prepared with our contingency planning. And in terms of our risk management, looking up the rule book on all the different things that we should be doing to prepare, including the dealing room contingency planning, I think that we were quite well prepared. We were also prepared for the possibility of actually having no one in our dealing rooms at some stage. But when the world finally took notice, and as the virus spread its tentacles around the globe, when the market started crashing around us, even though we had a slight leg up in the crisis, we really weren't expecting the markets to free fall the way that they did. During the 2008 crisis, I recall that one of the key risk management issues was really that of counterparty risk, including and especially that of other banks. And Lutfi, you'll remember this because you were working at a bank at the time. We spent so much time worrying about counterparty exposure. We just didn't know who had a funding problem, who didn't. So we were just risk averse and we just wanted to hold on to liquidity. And in this scenario, what we saw was, in the dealing room, the big risk management issue was that market liquidity had dried up immensely. So a typical ticket size that would be $5 million or so, or $10 million, reduced to a trickle. The credit market stopped operating almost completely. We would do a trade of 100,000 and the next price would be much, much lower. Bid offer spreads blew out to maybe 10 or 20 times of what they would normally be. And even the most liquid markets, for us, it was the Australian bond market, it really stopped operating. So the conditions in some of these markets, I think, were even worse than what it was in 2008. And the reality was that whilst the capital constraints and some of the risk management measures that the governments had put in place on the banks, they worked, but the reality was that because of that, plus the internal risk management policies, the banks were either unwilling or really unable to step in to intermediate the customer trades. We had customers calling, wanting to execute trades, and unfortunately a lot of the banks had to step away from taking principal risk because they had constraints on their VAR. A typical normal size market position blew out the VAR limits for a lot of the banks, and agency trades, which were intermediated, also took a lot longer because we had to match buyers and sellers. So this new regulatory environment, which was very effective in reducing leverage at the bank balance sheets, it really constrained the banks from playing their principal role of supplying market liquidity during these markets. And as the banks stepped away from their roles as market makers, really there was no one really to step in. The other big thing that we noticed during this crisis was the role and the size of the non-bank players, the hedge fund community, the proprietary trading funds, which has increased immensely in their presence and their capabilities during, since the crisis years. Some of these funds had leverage, 50 times on things like cash, which is futures, all of the stuff that I'm sure people in your participants are reading about now quite avidly. But even in liquid markets such as the US Treasury markets, and as the crisis unfolded, the price of funding skyrocketed, margin calls were made, the funds deleveraged and sold assets into increasingly more and more illiquid markets, which further exacerbated the imbalance and causes massive swings in one of the most liquid markets in the world, which is the US Treasury market. So regulators around the world, the FSB, the Fed, are already in the process, and some of them have already released some of the findings on what went wrong during, the market during this period. And I'm sure they will come up with some recommendations on how to remove the vulnerabilities that we saw in the market. But I do feel that perhaps some of the post GFC reform has been perhaps too narrowly focused on banks, and some of the NBFIs, and some of the role of the intermediaries also needs to be looked at to do a health check on the ability of the markets to handle these market stresses going forward. This is all with the benefit of hindsight, right? I mean, we all know what happened in March. And in the end, the central banks had to dive in with a coordinated effort across the globe, adding funding and liquidity and stepping in as a liquidity provider for the credit markets, for the fixed income markets. They provided FX swaps to central banks around the world, to ease the funding crisis that had developed in different parts of Asia. And of course, the governments had to come in with their fiscal efforts as well. So there was a lot that was going on at the time. And to me, the craziest part was the pace at which it all happened, right? In 2008, the crisis, probably developed for a lot longer, but it sort of took a year and a half. And the government response took about 6 months to materialize, right? And there were so many fits and starts, and can we do this and can't we do this? But this time, the central banks had so much more ammunition, the ability and the power to move very quickly to stuff out the liquidity and market destabilization. So, one of my colleagues in the dealing room in Australia said that what we saw in 2 weeks during that period of March is what we saw in 2008 crisis over a period of 6 months. So we saw it all in sort of, like at warp speed in this period. So it was really quite, draining, but incredibly energizing all at the same time. And then the other thing which stood out for me, which was, obviously the volatility markets blew out, oil markets were negative, gold markets were dislocated, all of this, which linked to physical markets and the interlinkage between the physical market and the derivative markets. I don't think that, those are things that we had ever anticipated in the past. Like, who would have thought that we will have to pay people to buy oil because it costs so much to store it, right? So all those were, things that I think, we'll have to think about going forward, about how we want, are the derivative markets really taking into account all the different anomalies of the physical markets? But to me, the way this crisis completely blew everything else away was that whilst we expected dealing rooms to be a buzzing hive of activity, like what we've seen in the previous crisis, like, all of you will have a mental picture or would have seen the Wolf of Wall Street and would expect what a typical dealing room would look like. But really, our dealing room had hardly anyone, because everyone was working from home. So we had this crazy period where you have this hum of these machines and, Bloomberg tickers and all of that going on, and no one in the dealing room, or one or two people in the dealing room. So another thing which was, to me, was unusual was how we relied on our systems, and all those years of BCP planning and all of that really sort of, it really came through. And, it was a really testing time for everyone. But I think at a sort of more personal level, this wasn't really just about the markets. It was about the people. It was about our resilience. It was about mental health. It was about our personal safety. It was about jobs. It just felt so much more than just the financial markets. And I think someone put it really well, that 2008 was crisis in the financial markets that spread to the real economy. This one felt like a real crisis of the real economy that spread to the markets, but we can still feel it in our bones. I'll stop there, and there's a lot more I can keep talking, but I'll give everybody else a chance to talk.
Thank you very much, Sneha. That was exactly 9 minutes, so you're exactly on the money. Terrific. So GFC compressed, but at the same time, everyone's working from home. A question I'll have for you later on is, if there wasn't a fear of counterparty risk in the way that we had in 2008 and 2009, what was driving the pullback in liquidity? Come back to you on that one. Next, our next speaker is Peter Giger. Peter is Group Chief Risk Officer and member of the Executive Committee at Zurich Insurance. He has extensive experience in insurance, reinsurance, including areas of finance, risk, strategy, underwriting, and regulatory management. Before that, he was with the Swiss Financial Markets Supervisory Authority, FINMA, as Deputy CEO and Head of FINMA's Insurance Division. Peter, welcome, and over to you.
Lutfey, thank you, and welcome to everyone. Yeah, I mean, it's a bit early to look back on a year because things may unfold still, but I call 2020 the risk of risk management at work. Because in most years, risk managers warn and evaluate and discuss. I mean, this year it was about mitigating, it was about calling the action. Now, as a global organization, Zurich was privileged to see it develop early in Asia. So when the wave rolled west, I think we were probably better prepared than most. As an example, we put in global travel restrictions very early on because we got concerned that airlines would kind of be grounded and borders would be closed. People called us hysterical. They said, that's totally absurd. That's not going to happen. But we said, we don't want our people stranded in such a world. Again, with the benefit of seeing what developed in China, I think we've been early. We even had the time to test home office in European countries, for example, which was only the case because of that. Now, for insurance, a pandemic is certainly not a black swan. And you see that our colleagues from Swiss Re, they have advertisements in Switzerland where they say exactly that. So pandemic was always in the mix. It was a scenario that supervisors tested and so on and so forth. I think what nobody had in the cards was the mitigation measure of locking down economies, of curfewing people. Kind of the pandemic as such did what it was expected. And that's why I think no one should be surprised that the technical losses for the industry were very manageable. I mean, for our company, it's in the order of magnitude of a major nat cat event, which in a way it was. I think the true impact on the insurance industry comes on the interest rate side. And I think the long-term question about, especially in the life insurance industry, how savings products can work in an environment of negative interest rates. How is that supposed to work? And I think that's a question on the value proposition of part of our business that is rather fundamental. Now, how could it happen? I think it's very human and it's very good for all our mental health not to stand up in the morning and worry about all the things that could go wrong during the day. So I think it was very human not to worry about pandemic, although it was very clear it was bound to happen and it would happen. But it was good for our mental health. Now, what I think was quite unfortunate was that risk management practices followed the human mental health pattern. I mean, I have to say I was shocked how many companies and institutions were caught in a way with zero resilience. And the prime example that we all read about was like hospitals having personal protective equipment for their staff for maybe a couple of days. When the items as such have no particular value and the storage wouldn't have cost much, but it was a total reliance on global supply chain without any consideration of kind of resilience to external shocks. I was also amazed how little some regulators trusted their own solvency regimes. I mean, when in Europe, the call came not to pay dividends and the call went to perfectly solvent, sometimes super solvent companies. I found that quite interesting, having been a supervisor before. And I also found it interesting because in a nervous market, such statements can also kind of create panic if they come at the wrong point in time. So I found that quite interesting. It was a moment of truth, and in some jurisdictions, apparently, the solvency regimes failed. I think what I also noticed and what concerned me as a risk manager was a singular focus on fighting COVID. That seemed the only thing that mattered. And even when you think about if you take it as a healthcare crisis, kind of nobody talked about the collateral damages of heart surgery being deferred, on other surgery being deferred, having to be postponed. And I think that was one of the things that, again, from a risk management perspective, was concerning. Very human. I mean, that's what humans do. They focus on a singular issue. They try to solve that. They forget all the rest. Quite dangerous. in the bigger picture, I think it's the planet is still warming. I mean, we are going through an extremely warm November here. There is nowhere near enough action on that. Pension systems are still collapsing in many countries. There is no discussion of that. And I think that's, on a longer term perspective, I think really, really concerning is kind of we will get COVID under control, and there will be a day after. And I wonder kind of whether we do enough and whether we invest enough to be prepared for that day when kind of the next problems ahead of us. But I think at the end of the day, being a risk manager, I have to be an eternal optimist because it's good for my mental health. Right. I think in the second wave, from a company perspective, that's probably our biggest concern. I mean, we have operational resilience. I would say, no doubt, we know that works. People know how to work from home. I mean, we do these events that kind of in the traditional world we would have met, and it would have been a day out or 2 days for some of the overseas colleagues out of our calendars. We may not have committed to it. So we get new opportunities to do things. On the other hand, we get concerned as a corporation about our people being isolated. For many of us, the job offers most of the social interaction, and that we see that as a major risk that we need to manage somehow over winter. And I think that's from a company and a personal perspective at this stage, our biggest concern. Yes, we have the vaccination kind of light at the end of the tunnel news, but I guess it's a long way. And I don't like to talk about the new normal. I mean, whilst I'm getting old, I've never seen the world in a normal, steady state. And so we should not promise to anyone that there will be a new normal after it. There will be just the next wave of changes required.
Okay. Thank you so much, Peter. My question to you would be, you mentioned the planet is warming, pension systems collapsing. Does the COVID experience make it easier or more difficult to have conversations about these other longer-term chronic issues? I'll come back to you with that. Next, I'm delighted to introduce Mohit Joshi. Mohit is president of Infosys, in charge of banking, financial services, insurance, healthcare, and life sciences businesses at Infosys. And if that's not enough, in addition, he's just been appointed this month as a non-executive director of Aviva. Apart from his current global role, Mohit has led businesses in the US, Europe, India, and Mexico. Mohit, welcome, and your startup perspectives, please.
Thank you, Lutfey. And it's really a pleasure to be here. So I'll frame my comments in 3 parts, right? First, just to give you a little bit of a background and a sense to how we approach the crisis. Then to talk about the specific risks that we saw in the crisis and how we sought to address them. And then finally, what are we seeing today? So if I start out, if I just take a look at our business overall, it's about 250,000 people, about $13 billion in terms of revenues, and about 1,200 clients. It's a mix of a software business, a services business, and a platforms business. And when the crisis first hit us, right, when we first got wind of this, maybe in early January, we have a reasonable sized operation in China also. We've got about 3,500 people there. But it seemed like a China crisis in January, seemed like a Asia Pacific travel crisis in February. And I think it's only in March that we realized how quickly this was spreading. And I think, like a couple of people have said in the past, the speed and the global synchronization of the lockdown, I have to say, caught us by surprise. Maybe it shouldn't have, given the fact that we'd seen this happen in China. But the speed with which it spread, I think, is the one that really caught us by surprise. Now, again, we were sort of lucky in the sense that we had a global business, but equally, given the huge dependence that clients have on technology, given the fact that many of our contracts historically have required our people to be working from offshore development centers or even from nearshore centers that are very closely monitored, meant that we had to go and take a look at our contracts to see what is the work that we could do. Towards the end of March, when the crisis really hit us in full force, for us and for all of our global peers, I think the expectation was that that revenues would drop by at least 10 to 15% was the market expectation. For us, I think one of the strengths that we had is historically, given the distributed nature of our operations, we've always had to have a very strong business continuity and disaster recovery focus, and very strong enterprise risk management policies in place. So this is how we approach the crisis. During the crisis and now, we are tracking broadly 6 parameters, right? So there are 6 things that we're tracking as a company from a risk perspective. The first is very clearly health, right? And here we're using both internal data, which is how many of our employees have been tested, how many of them have been tested positive for COVID, what are the nearest contacts. Beyond COVID, what is the general sort of physical health and mental health of our teams? Obviously, people are working longer hours, and because of the isolation that people find themselves in, there are concerns about mental health, right, and long-term resilience. So health is clearly the first and most important area of focus for us. The second area of focus for us was, work from home. Now, again, being a company that has always worked in a globally distributed manner, this was slightly easy for us. And so we were able to pivot to having 93% plus of the employees working from home just in the first week or so after the lockdown measures were announced. But making sure that, in the first phase, it's about making sure that people have connectivity. And it's a huge logistical operation because you suddenly have to provide desktops and laptops, and in some cases, UPS equipment. In some cases, bandwidth arrangements need to be made for, like I said, a 250,000 people. In the phase after the operational resilience was established, the work from home focus moved to productivity. How do we make sure that that these people are productive, and how can we demonstrate this level of productivity to our clients? So work from home and the sort of technology that is needed to enable that was the second focus. The third focus for us was obviously around security, and cyber is a huge piece of it. Like I'd mentioned previously, historically employees had been working, from fairly tight controls from certain defined areas with certain security protocols in place. We had to make sure, and thankfully this is an area we're over-invested in. Some of our peers got very badly hit by cyber attacks. Is making sure that your cyber arrangements are in place, and that equally the security protocols that you have from an operational perspective, that you're able to have some form of fashion of security controls in place, for our clients to make sure that our contracting arrangements then reflected the new reality we were living in. So cyber is the third piece we were focused on. From a risk perspective, the fourth area of focus for us was cost. Like I mentioned, in the early days of the crisis, we were expecting, double-digit reductions in revenue. There was a fear of double-digit reductions in revenue. So how do we think about cost, and how do we think about our own balance sheet? Thankfully, we had no debt. We had, a huge amount of cash in the balance sheet. But equally, we wanted to make sure that our customers were solvent. So monitoring our customers to make sure that that they had the wherewithal to pay us, restructuring payment arrangements in certain cases, but also taking a much closer look than we otherwise would have had at their own solvency and liquidity and creditworthiness. So that's the fourth area, and this is a mix of cost measures and defensive measures from a balance sheet perspective. The fifth thing for us was from a supply perspective, right? Clearly, our business, to a degree, is dependent on people traveling across various locations globally and traveling within a particular geography or within a country. How do we make sure that we're able to provide the level of talent that is needed to run global businesses? We hire 30,000 plus people every year. How do we make sure that we can onboard people in an environment where only remote onboarding is possible? And so this means an investment, and I'll talk about it later, an investment in making sure that that you have virtual models of onboarding people and training people. And the fifth and the sixth factor that we were covering from a risk perspective was the supply piece, right? Was the demand piece. which is how do we make sure that we're able to get a handle on demand, across sectors, across clients. How are we tracking, either reductions or new opportunities that are coming up? How do we make sure that there is a pretty straightforward channel between the sales organization and corporate to make sure that we're getting as clear as possible a real-time picture of demand. So it is across these 6 parameters that we were collecting data and we were reporting it to the board, first on a weekly basis and then on a bi-weekly basis. So that's the background and the measures that we took in place. So how have we done against these so far? I think, so far, we've actually had a very good crisis, I have to say. 99% plus of our employees are still working from home, with the exception of China, where we've almost gone back to normalcy. In all of our other markets, people are largely working from home, except for a few people where their role requires that they be present at one of our sites. And again, there we've made technology interventions such that you're able to check in remotely, you're able to comply, you're able to confirm that you can comply with the requirements. You have touchless biometrics to enable you to enter the office. You have remote temperature checks and a variety of platforms that we've built so that within the offices itself, we can check for mask compliance, we can check for where people may be gathering in unhealthy numbers. So, like I said, business is pretty much back to normal from an overall employee utilization perspective. In the first quarter, the quarter ended the 31st of March, we saw roughly a 0.8% reduction in revenues, right? But if you look at it now, for the quarter ended September the 30th, we're now actually growing as a business. So we're growing at 3% plus year on year. And we've been able to, in the feedback that we took from our employees, I think the number was 93%, but something like 87% of the employees are happy with the arrangements that they are, and they're comfortable working from home. 90% plus of our clients thought that the measures that we've taken on a 7-point scale were, either very satisfactory or satisfactory. And so overall, from a risk management perspective, from where we are as a business, I believe that business has stabilized and things have come back to, to a level of normalcy. From a personal perspective, honestly, I've been surprised at how comfortable it's been, right? How smooth the journey's been for our business. If you told me in January, we'd be talking about the existential risk to a business. But I think given the focus on tech, given the operational resilience we were able to demonstrate, things have stabilized at a remarkable pace.
Thank you. Thanks, Mohit. My question to you would be around the point you only briefly mentioned, which is cyber. The fact that some of your competitors, you said, were wrong-footed by cyber attacks. And we hear a lot about banks in variable states of preparedness when it comes to cyber. And we hear about, you've got general cyber attacks, and then you have the geopolitical layer now with the US-China decoupling, tech war, new Cold War, and so on and so forth. How important is that as a risk factor? If we're studying about risk in the financial system, how important is that as a risk factor to precipitate potentially the next crisis? That'll be my question to you. Also to the audience, please start populating your questions in the Q&A box because it's going to get really rushed and we want to make sure that we cover your questions so you know where to go for the questions. Now, we've just heard 3 voices from the industry. So it's time for the academic side of the fence. And please welcome Dr. Grace Lordan. Grace is the founding director of the Inclusion Initiative at LSE, focused squarely on the practice and effectiveness of inclusion measures in financial services firms using insights from behavioral science. There's the traditional risk measures of value at risk. There's also cultural capital at risk. It's a term that the New York Fed has been using recently. And I would like to also draw attention to a particular report that I like personally. It's available online, one of Grace's reports on how to counter the 10 ways in which lockdown or working from home has exacerbated the risk of exclusion in the workplace. So Grace, thank you for joining us, and the floor is yours.
Thank you very much, Lutfey. I really like the format. So I like that you give people a question and you tell people that you'll come back later. I'm really looking forward to some of the answers. So thank you for that great introduction. Today, I'm going to talk about behavioral risk in financial services. And for me, this is the most important type of risk. And I would say that because I'm a behavioral scientist, but it's not just that. It's a major driver of compliance risk, reputation risk, operational risk. And I could actually go on. And, I'm sitting in the UK today, and here where the regulator stipulates that information asymmetry on the customer side is actually the business's problem, behavior and how actually customers behave becomes really relevant as well. This is usually why I'm invited to talk, but that's not what I'm going to talk to you about today, because today I have even another reason to claim to you that behavioral risk is the most important risk of our times. And the reason is because in the midst of a pandemic, we set most of our professional workers home, when how we actually monitor their behavior is largely done by machines, tracking emails, etc., where we haven't yet actually cracked how we invest in culture. And for me, this is really interesting. So back in January, we did a joint session at LSE with the New York Fed with John Williams, and we spoke a lot about cultural movement. And then we were talking about the fact that we want to move towards culture. You want to move towards thinking about how you actually get people behaving well without poking them with a stick, because it's actually bad for business if we don't do that, because there's evidence to suggest actually that the more monitoring we do, the less creativity we get, the less productivity that we get. And it's ironic that now we've actually had to go home, so we need to figure out how to do that remotely. So I'm going to try to think to convince you that this is important, and then if you're interested, we can talk about some of the solutions in the Q&A. So the first thing to say is that it's absolutely true that physical distance and psychological distance are related. The further I'm away from the person monitoring me, or the more detached I am from my firm, the increase it is that I'm actually going to do something that's not particularly good from the firm's perspective. So this moves away from the kind of rational model that economists like, where we kind of say a person is going to do the wrong thing, or where we increase behavioral risk. And we can think about that by looking at costs, benefits, and risk, or upside, downside risk. Rather, it actually adds into the fact that how I feel about my organization, or to use Lutfey's words in the New York Fed, its cultural capital, really matters with how I behave at work on a day-to-day basis. Now, there's one thing that really increases whether or not I feel attached to my firm, or whether I feel that I culturally belong, and that's the interactions that I'm having with people. So the interactions that I'm having on a day-to-day basis. And it's really interesting. So Lutfey mentioned the kind of report I wrote thinking about virtual inclusion. And the reason that I wrote that is because as soon as the pandemic hit, people were asking the question, how can we recreate those water cooler moments? How can we recreate those team meetings from one perspective of thinking about employee mental health? But it also meant that thinking about how can we improve culture when we have this distance so that it's actually good for business in the long run. The second thing to say when we think about behavioral risk, as uncertainty goes up, the inclination for people to actually behave incorrectly also goes up. So you can think of this as a correlation. There's some causal evidence from the lab. We don't have it in the field yet, but the two definitely go together. And if you think about this, if you think about what uncertainty actually means, very often we're thinking about this at an individual level. So if a person is having a bad time at home, maybe they're getting a divorce, maybe there's a sickness, maybe they're in financial distress, they're much more likely to act out at work. Now, I'm not necessarily saying that what they're going to do is going to be to break the rules of the company. It could just be acting out negatively and making their colleagues feel uncomfortable. But all of this leads to culture. And right now, all of us are kind of going through challenging times. So the pandemic itself is creating uncertainty. And, Sneha said this really well. It's not the case that this is a crisis for, it's not the case that this is a crisis for financial services. Financial services are reacting to this massive health shock that has created that uncertainty. And most of us don't necessarily know when it will end. So, we have this idea of a vaccine that's standing somewhere in the future like a unicorn, but the exact timing of when we actually go back to work is keeping us in uncertainty. As employees and as human beings in general, we tend to react quite badly to that. And the last thing that I'm going to say is that, the move to virtual working since March if for companies that actually have social network maps, what that basically means is that I can see who's communicating with who, who's Zooming with who, who's choosing to speak to each other on the phone, has provided some good evidence that it has entrenched in-groups. Now, in-groups basically means that you have particular people in the organization who actually like each other. They tend to spend much more time together. So you might say, well, what's so bad? Well, if you're a company that's going through redundancies, then that might be bad for you if it's in the out group. But for all financial services, in-groups are really bad for business. Their presence is associated with rent seeking. It's also associated with poor information flows, essentially meaning that what you're actually creating is more entrenched silos as compared to the past. I think all of these points are important. So we need to think about how can we actually make people feel more attached to the company, even when they have that physical distance. They're not getting to enjoy the hum of the trading room. We need to think about culture as kind of this living, breathing organism that actually, if we manage to improve it, it allows us lower monitoring of our employees, which is really important now because we can't monitor them like we used to in the past. But even without the at-home working, monitoring isn't actually good for somebody's morale. So moving towards good culture and away from excessive monitoring might actually bring back some of that productivity, some of that creativity that we had before the GFC. Uncertainty, there's not a lot that we can actually do about it, but we do need to get really clear about our communications at a higher level management level, and also at a mid-level management level within teams, again, trying to kind of recreate the attachment that we had when we were working together. And we also need to keep an eye on in groups. And I want you just to make no mistake, I'm not pushing for, a return to business as usual. And I also don't like the term new normal. I think that there were actually some great gains to keeping some of the fantastic increases to flexibility that we've had during this time. But I do think that we need to see that we're actually on a learning curve of behavioral risk. We don't actually really know what's happened in some people's homes. And I think adopting an experimental approach to improving this type of risk will allow us to establish a better culture, reduce the need for monitoring, and also allow us to actually get to a better place in the absence of going back to this kind of 9 to 5, Monday to Friday week. Of course, I'm talking to people in financial services, so I'll say 7 to 8, Monday to Friday week. I'll finish there, Lutfey.
Thank you, Grace. I could ask you so many questions. I guess maybe the one will be, if I understand it correctly, the natural thrust of distancing, working from home, seems to be to reverse some of the progress made in inclusion and cohesion. And so perhaps leaders in the business need to be more deliberate in being mindful of the natural tendency to pull things apart. And if so, what are some of the hacks, some of the solutions that we could apply? In your report, you mentioned issues around virtual presenteeism, for example, or the attribution problem. Is my boss attributing my work correctly or attributing somebody else's incorrectly because he or she is louder on the Zoom call, for example? So what are some of the practical hacks you can provide? I'll come back to you on that. So, and now John Danielsson. John is a reader in finance at LSE and director of the Systemic Risk Center. When I was in the industry, we knew John mainly for his 2002 paper, in which he and his co-authors highlighted the risk amplifying properties of Basel II regulations. And, we saw how that story ended. They are also credited with classifying risk according to exogenous and endogenous properties, which is a way of framing that I personally find very useful. So John, over to you.
Thank you so much, Lutfey. So being the academic and having slides, I wanted to have, because I have numbers. So if the slides work, then it's fine. Otherwise, do let me know.
They work.
Fantastic. So I'm also a historian, sort of amateur historian. I would like to ask you to think in your mind, what year in the past century do you think has the highest risk if you look at the financial markets as a metric? So if you just take the S&P 500, and this is the annual volatility, the Great Depression 80 years ago is the highest risk event, followed by 2008, and now COVID-19 is the third riskiest event we have seen. But the question to you is, do you think these are the three riskiest years in world history or not? And I sort of tend to disagree strongly, because in the year 1962, we almost had a nuclear war. And a nuclear war is the ultimate tail event when all asset prices go to zero. And in 1983, we had another almost nuclear war event, which casts quite a good light on how we can think about risk in the year 2020. So the story is that the Andropov was then the head of the Soviet Union. He got it in his head that the United States was about to launch a nuclear preemptive attack on the Soviet Union. He had no evidence for this. But what he did was that he instructed his KGB agents to find the evidence. And just imagine, you are the KGB resident in Paris or Singapore or London or Washington, and you are told by your boss, find the evidence for a nuclear attack, and otherwise you'll be sent to Minsk or Murmansk or Siberia. Of course they found the evidence. And this is a prime example of a confirmation bias. If you look for something in the risk management systems, you will find the threat you're looking for, even if the threat is not there. And then we come back to the man who saved the world, because in 1983, the early warning signals of the Soviet Union, they told us the United States has already launched a nuclear attack. Respond. And the person who was in charge at the time, Colonel Stanislav Petrov, he decided he didn't trust the early warning models. He didn't launch a retaliatory nuclear attack. And his reason not to trust his risk models is the reason why we are all alive today. He passed last year. It's a very nice biography of him on the BBC website. So let's connect this to something more real. What drives risk? To begin with, the time between decisions and crisis is many, many years. The crisis in 2000 did not happen because of anything done that year. It happened because perhaps in 2003, all the signs told us risk is low. So everybody says, there's nothing wrong with a little bit extra risk. But in the process, in aggregate, we forget what Minsky said, stability is destabilizing. Because if we find ourselves in a stabilizing environment, we behave in a way that creates instability. So how can we put some structure on this? So imagine this afternoon, the US stock market goes down by $200 billion. Nobody really cares. In 2008, potential and not even real subprime losses of less than 200 billion. And oh my God, the world has come to an end. There's a global crisis. And those two events put a nice way to frame risk. The risk we know, we prepare for, the known unknowns, that's the stock market. The risk we don't know, the unknown unknowns, they are the dangerous ones. But how do you prepare for an unknown unknown, which is sort of the theme of how I think about risk? And that comes back to what Lutfey said earlier, which is endogenous risk, a concept we came up with here in LSE some years back. Exogenous risk takes the view that the shock to the financial system arrives from the outside the system, just like the asteroid that wiped out the dinosaurs 65 million years ago. Certainly there was nothing the dinosaurs did to precipitate the demise. Endogenous risk is the risk created by the interaction of market participants. All serious risk is endogenous. How many risk models assume risk is exogenous? Endogenous, almost none. Almost every risk model known in the world assumes risk is exogenous. That is, you can react to it, but you don't precipitate it, which is fine most of the time, but not in times of stress. So let's make this slightly more concrete. Endogenous risk matters when we react to and affect our operating environment. My students always freak out when I tell them, when you start working, you will change the financial system. Everybody in it changes the system. And that means we cycle between virtuous feedbacks and vicious feedbacks. Perceived risk is what your risk model tells you risk is. The actual risk is the hidden but ever-present monster that's hiding under the bed. So how does this look in a more real world? This is a bubble, typical bubble. Prices go up at a faster and faster and faster rate. We say they go up by the escalator, and then they collapse. We say you go down the lift, or if in the United States, you go down by the elevator. If you measure risk along a bubble path, the risk goes down as the bubble gets higher and higher. An easily verified empirical observation. Those of you old enough to remember a Dire Straits song from the 1980s called Money for Nothing. This is a money for nothing environment. Risk is going down and prices are going up. Fantastic. Except the actual risk, the one you don't pick up, is going up along with the bubble and goes down when the bubble goes down. So what does the measured risk tell us? It tells us risk is too low when things are good and too high when things are bad. Risk models, they tend to pick the risk incorrectly up in all states of the world. And with that insight, we have a long way to understand the many financial crises we've observed. So to take us back to the first speaker today, and let me ask the question, what is the probability seen by the market of at least 20% drop in the S&P 500 over the next year? So this is a one-year event. How did we get it? This comes from options market. And if you're interested, we have a conference on Friday where we go through this in a lot more detail. It's a major focus of our center. In 2008, the probability of a one-year loss of 20% went from 10% to 33%, stayed at 33% for a year and a half, and slowly came down. In 2008, this shot up in about 3 days, went from 10% to 30% at the end of February, and almost immediately came down to 15% where it stayed since. And by the way, this happened before the market crashed. So if you had seen this plot, you could have forecasted the S&P quite nicely. And to combat what policy remedies worked, when we call this market fear. Liquidity policies and household and company support has no impact on market fear. The biggest factor driving this is the Fed swaps. And if you do the same plot for countries that did and did not receive FX swaps, you find that the most important intervention was the FX swaps. So before I run completely out of time and Lutfey kicks me off, this comes back to what we've called the dissonance of the long and short run. What we care about most of all is the long run, or we all say we care about the long run. How many people who actually work in the financial system think long term? I think almost nobody. Because the long term is not compatible with how we measure and we manage risk. Standard industry practices and human nature, human behavior always drive us to the short term. So we become really, really good at dealing with what we care about the least, the known unknowns. And all the rigorous scientific measurements of risk, the stuff I teach my students and you employ in your companies, they all verify that with all the fancy state-of-the-art risk dashboards, all of which provide reassurance, and they all tell us you can ignore the long run. And there are practical implications of this. The performance of long-term investments like pension funds, sovereign wealth funds, insurance reserve funds all suffer. We get false diversification. Someone might choose to buy private equity funds with low short-term volatility because that looks low risk, even though they're long-term co-integrated with the equity markets. And if we find the short-term risk dashboards as reassuring as we did before the previous crisis and in the past few years, we just create conditions for the next crisis. Always remember Minsky, stability is destabilizing. And with that, I stop.
Thank you, John. That gives me a set of questions. The one I will zoom in on is, if I understand it correctly, you're saying that there's not only too much focus on the short term versus the long run, but the hyperactivity in the short term actually makes it worse the risk worse in the long term. It's almost as if it's storing up risk for later. It's like there's sold optionality somewhere. The other thing I think, if I understood you correctly, is that you're saying almost as though there's been too fast of a reaction from the Fed and the other monetary authorities, which is somehow storing risk for the future. So my question to you will be, first of all, did I understand it correctly? Do you think that we've just pushed back the precipitation event with the short-term movements, short-term relief that we saw in the markets? So I'll come back to you with that one. We've now done a full sweep of all of our panelists. And before we open it up to the audience, let me ask a question each to each one of them. Sneha, to you first. My question was, what caused that liquidity drying up situation, given that this time round counterparty risk was not the major concern?
Yeah. So, Lutfey, I think I think just to answer your question, I think that the answers are not very complicated, right? It's really back to funding and capital. At the end of the day, those are the two things that drove that decision making. So the capital issue was quite simple. I think post the crisis, and after the Dodd-Frank and the Volcker rulings, the banks are not really in the business of proprietary risk taking. Their job is to majority of the job is to facilitate customer business, the VAR limits and the way the risk management policies are set up are all done to facilitate that. When you have moves of this type of sizes, most of the banks would have had a lot of issues with how the VAR limits were, and the risk management policies of the banks would have kicked in to say that, okay, you got to watch out here now, with the same sort of limits that 2 weeks ago you would have operated as per normal. In this environment, you're full up, right? You're at your risk limit. So I think that there's something to be said for the risk appetite of the banks, the capital that was attached to the VAR, and then the other thing that was developing at this time were the asset books as well. So the banks had asset books as well that were also looking stressed. I think a lot of the corporates were also drawing on liquidity some of the rolling funding facilities that were provided to them. So the liquidity was a big concern as well for the banks. What happened with LIBOR and OIS, right? Fed cut rates by 100 basis points, and you see the spreads going in the other direction. So, and there's a lot of pressure also on the CP markets, and particularly in the US with, the money market funds, and where the Fed had to come in with some rescue packages for that as well. So all in all, I think the impact of the NBFIs in the treasury markets, the liquidity constraints of that's right, the non-bank financial institutions, the funding constraints in the CP and the CD markets, in particularly the US, which caused a lot of liquidity drying up in the US markets. And I think John called it out very well that when the Fed came in with the liquidity swap facilities, which meant that players who were not natural players in the US dollar market had access to US dollar liquidity, that's when the funding stress and the funding markets and dollars started to abate, because until then they had to use their FX, they had to use whatever means they had in order to raise US dollar liquidity, because that's the bit that was constrained. So I think that really it was an issue of, it was not so much a counterparty exposure that banks had the money, they didn't want to lend it. It was really an issue of preserve liquidity and the funding that they had. They had their asset books were being drawn upon, and then they had limitations on their VAR and their risk appetite, just as a function of what happened post the GFC. And therefore, they stepped away from their role of being a market maker and being, the ability to provide liquidity. And some of the hedge funds that typically would be supplying liquidity to these markets, they started draining liquidity from the markets instead. So those were some of the reasons where I think liquidity dried up in the markets. But, frankly, maybe John, as an academician, might be able to answer this a bit better.
Thank you. I think your last point is the one that I'm quite taken by, which is that over the years, as banks have reduced their inventory capacity and their ability to warehouse risk, the impression was, look, all of these non-bank financial institutions are going to step into the breach and look, they are supplying liquidity. What's the problem? It turned out that many of them are fair weather providers of liquidity, whether it's in the funding sense or in the trading sense, foreign exchange, for example, the platforms and so on. So I think the fact that liquidity is state dependent, or the supplier can turn into a demander, is something that I take away as an observation. Peter, should we come to your question now? So does COVID make it easier or harder for us to talk about the other long-term chronic issues?
I think it makes it harder, actually, because there is a real risk of a false self-confidence. Like COVID was a problem that lent itself to human problem-solving strategies. Focused, lots of adrenaline in the system, get it done, move on. Other of the problems that we talk about will not respond to that type of approach. Like climate change, once the numbers really come through, you can pump as much money as you want into the system. It will not reverse the effect. Infection rates come down if you lock down. The temperature will not come down again. So I think there is a real risk of a false confidence in the ability to manage the issue last minute. I'm also concerned that many of our risk management practices are severely impaired, because many of the things we're doing based on the notion of market consistency. But when I look around post-COVID, I hardly see any market that is not manipulated by public players. I mean, who believes that interest rates in Europe are the result of a free market? Certainly not. Because we all know that that Europe cannot afford a lot higher interest rates because governments couldn't pay the interest, so it won't happen. But in our risk management practices, we assume we can observe market consistent information and base our models on it. So I think there is a significant long-term impact of what we've just seen that will make us need to think about kind of how we think about risk, how we measure risk, and how we manage risk. All of which is, for the colleagues in academia, I think a tremendous intellectual challenge. For us practitioners, it is a practical problem, because we have to ask ourselves whether we can really take these models at face value. What do they really tell us?
You mentioned that the fact that we've seen a dramatic drop in interest rates and negative interest rates in many cases, and interest rates will probably remain lower for longer. And so the lack of a yield curve or a slope in the yield curve, does that mean this is the end of the use of finance as, an investment vehicle, a savings vehicle, pensions and insurance?
Well, I mean, the way I think about it is that basically the governments tell people to save for the old age, but the national banks tell them not to.
Right.
Because financial repression is a signal not to save money, but to spend it. And so, I mean, how the individual will get their head around and act rationally is a very interesting thing. I mean, the whole policy making is severely inconsistent. Again, there is the long-term problems and there is the short-term issues. And as Jan rightly said, I mean, we tend to fix the short term at the cost of the long term, which we declare important, but we don't live up to that declaration.
Right. Okay. Thank you. Mohit, your question. Cyber and geopolitics. Is that the risk factor we should be looking at?
Sure. So let me cover the cyber piece first, Lutfey. And when we say cyber, right, we're really talking about a bunch of things which are in the same continuum. So we're talking about, issues around identity and access management. We're talking about how you uncover threats, vulnerability management, looking at your tech infrastructure at length, looking at governance, risk and compliance, looking at cloud, looking at the new risks because of IoT coming in, and to have a proper systemic response to these risks. What we tell our clients is that you got to think of it in 3 or 4 buckets, right? First is the bucket which goes towards monitoring and towards intelligence. How are you looking at these threats? What are the external data sources that you're getting? How are you thinking about IP leakage? How are you thinking about the risk to your reputation and to your brand? How are you searching for these risks, right? Which is, are you looking at anomalies? How are you able to detect them? Beyond that, once you've detected the risks, how are you diagnosing it? How are you measuring them so that you have a prioritized response? And finally, how are you, managing and responding to them? So it's obviously a huge area. Cyber has become even more significant because every business now is dependent almost completely only on the digital channel, both for engaging with clients and for engaging with employees. From a banking specific perspective, I'll talk about 3 things that I think are of a concern to us. The first is the prevalence of legacy in financial services more broadly. And while boards are very seized with the cyber risk, they're really looking at cyber more from a 100,000-foot level, right? So every single CISO or Chief Information Security Officer I've spoken to has told me that boards are ready to spend almost any amount of money on advisory about emerging North Korean risk signatures, but nobody's willing to put in the money to revamp the legacy systems that they have. And to me, this is a huge risk. The second is the risk that comes from from a move to the cloud, which I think is manageable. At the end of the day, the cloud providers are investing very heavily in security. And just to make a generalization, I think your data on the whole is safer in the cloud than in your own proprietary data centers. But there are also new kinds of risks emerging because of IoT. It's not very big in financial services just now, with the exception of insurance, but it will become more significant. So how do you think of legacy risk and how do you think of new risk? And finally, I think the third risk is about internal bad actors, right? And if anything, this risk has gotten even more amplified with people working from home. Historically, this has been the biggest single source of vulnerability for most organizations. And it's harder to manage or police because you can police the perimeter very effectively. It's harder to police within the perimeter where the actors have full knowledge of the measures that you may be taking or of the processes that you may be following. From a geopolitical perspective, look, it's while this is an issue of concern for us, the reality is that we saw this almost 5 or 6 years ago, that large banks or large financial institutions, for instance, were very reluctant to in the West to buy hardware or elements of their networking technology from Huawei because they suspected that this was coming. Right? They suspected that their security services would be reluctant for them to buy Chinese-made equipment. So to that degree, I think the markets are prepared for for the fact that they will be living in a world where there are limited options to what they can buy, and this is an impossible question to answer because so much depends on the stance that the new administration takes or how China responds. From our business perspective, I have to say that we have not seen too much of a impact on our business because of this, and that could partly be the fact that our Chinese business is not very large in the overall scheme of things for us.
Thank you. Yeah, I read an article in one of the newspapers about how the number of cyber-related fraud at a retail customer level of banks has skyrocketed in the last few months. But how many of those customers are not being compensated? So the responsibility is very much been pushed to them. So the feeling is, and it dovetails a survey, I think, by Accenture that I saw, which shows that the vast majority of banks that they surveyed, they're rolling out technology for efficiency reasons without necessarily getting on top 100% on the security implications of those. So, and if that is true, then that is quite scary because you're telling us, the end users, this is for your convenience, do online, everything online. Oh, and by the way, you're also conscripted soldiers in the fight against cyber warriors. And if you don't do it properly, then it's your fault. So there's a little bit of a bait and switch in this.
So Lutfey, if I can just respond very quickly, I think there are two things here. Bulk of the retail cyber attacks that we see are really social engineering attacks. These are not, high-tech attempts. These are, phishing that are preying on the sort of fears of normal, investors or savers, right? So these are not very high-tech attacks, most of them. The second point, I do take your point. The reality is that we're moving to a new age where there is a lot more focus on agile, there's a lot more focus on automation, and there's a lot more focus, rightly, on customer responsiveness. What this means, though, is a number of the controls that we've historically embedded into your, into your normal standard operating procedure. These are being overwritten, and so to that degree, there is that trade-off.
Right. Thank you. Right. Grace. Solutions. We need some solutions.
I do like that Peter brought up, the idea that some of the models that come out of academia don't really speak to practice, because I think, if you take an economist kind of standpoint and you think about decision making, we kind of constantly talk about cost, benefits, and risk. And I think the first thing to say is, when people are evaluating things, it's their beliefs about cost, their beliefs about benefits, and their beliefs about risk that matter. And that basically means the financial services need to know what their employees' beliefs are and what their customers' beliefs are, which is really, really difficult. And I think second to that, what you asked for is kind of, hacks for the fact that we can no longer rely on the control environment. I think a lot of it comes down to this idea of kind of, firstly, post-choice rationalization, which basically means that you want to make it as hard as possible for your employees to sleep at night if they've done something negative, so that when they actually do something negative, they're not likely to repeat it, which really kind of speaks to this idea of incremental cheating, which was shown to be true in, mis-selling scandals, in LIBOR manipulation. It wasn't the case that people decided to get together and do a great heist. People started off small. So you have this idea of incremental cheating. And I think both of those kind of beliefs and changing post-rationalization really comes down to the idea that what you need to do is improve the interactions that you're having with your employees. It's really as simple as that. So this can be as simple as trying to recreate, those water cooler moments, those team moments, through having Zoom drop-in. If you're the person who's in charge, to really sharpening your communications to give more certainty. So I spoke a lot about uncertainty, and I think that it's really important in scenario planning that we realize that it's the people's beliefs about what we're actually saying to them will be the ultimate determinant about whether our scenario plans actually hold true. So the communications that you give them become really, really, really important. And I think if you're somebody who's really interested in kind of old-fashioned controls, kind of releasing the idea that what we did in-house is what's optimal, and kind of moving towards things along the lines of people analytics, social network mapping, which give you that kind of spirit of the old-fashioned control. So you're still auditing your employees, but I think they also allow you to audit your culture as well. So I'm a great proponent of kind of decreasing monitoring and trying to improve culture within organizations. So I see this as kind of a great experiment to allow us to get to there.
Grace, in your conversations with the city, do you get this dilemma that I know a lot of my former colleagues have, which is under the senior manager regime of the FCA, supervisors, particularly the ones that are flagged as material risk takers, they have personal or criminal liability for supervisory lapses. How do we say to them that, release the reins, don't do too much monitoring, let 1,000 flowers bloom?
Well, it's interesting, Lutfey, because I've had this conversation with the FCA, who really are pushing culture. So they're really pushing in the direction that I'm pushing on, but they're not saying decrease monitoring. So they're essentially saying for both. But, I think the regulator needs to realize that, the pandemic was a shock. We moved towards home, and then the risk of having one of these blunders has actually increased. So this is about risk management and not zero risk as well. And I think sometimes when you talk to certain regulators, they do mix that up. Right. So from the perspective of the senior management regime, I wouldn't be declaring loudly that I'm decreasing monitoring, but I would be moving towards trying to improve culture in my team and seeing whether or not that alters behavior beyond what you've been able to do already. And I think that let's see needs to be done in a proper evaluation. It can't just be a gut feeling that something is working and not working.
Right. The other thing I learned from every session that I watch of yours is how much of what you suggest is experimental, is trial and error. It's really, the insight is in the variation, not in the average or the median. And those of us who are used to thinking of, a reductionist measure, what's the one thing we can do for everyone? The first learning for us is that, I guess, behavioral insights are tailored by definition. So you need to look at subgroups as opposed to one size fits all.
I think any policy recommendation is, so it's not just behavioral. Peter spoke about, European interest rates, and his conclusion is specific to the context, but we really need to understand the context in order to apply some of these models. So the reason the economics models are failing is because they're not taking into account the context matters. And that's what individual differences is as well. So what will work in one institution might not necessarily work in another because they have different cultures. And that heterogeneity is really important to know. And what might work in one country might not necessarily work in another. And, in medicine, we talk a lot about this idea of our genetics versus things that are malleable by the environment. So it baffles me when we're dealing with people why we think that there's going to be one lesson when we move to the social sciences. So for me, in the social sciences, we have these core lessons and we have these context-specific lessons. And because we haven't taken an experimental approach to figuring out whether the models that we have actually fit the data, what their cost benefits are, we're so behind what medics can actually tell us about genetics versus environments versus their interactions. And I'd love to see us, catch up with that.
Right. Thank you. Great. John, so I guess my question to you is, what's wrong with being short-term focused?
Let me put this into a slightly broader context and answer the question you asked after my talk, because I've been thinking about it since and listened to other presenters. So you asked me about what is the consequence of the intervention in March, and I think the more I think about it, the adverse consequences of what the central banks did in March are hugely underappreciated. It'll be a lot more damaging in the long run than we give it credit for. And here is my logic for this. Twice in the past 10 years, we have asked the central banks, and primarily the Central Bank of the United States, to bail out private sector financial institutions, and even the corporate sector in a lot of countries. So someone might ask, what is the point of a private sector banking sector that has to be bailed out every decade? And why should the central banks, who gained a lot more powers as a response, why would they condone the activities that lead to that? So I could see a lot more anti-capitalist discussion around the world as a consequence of this, questioning the integrity of a private sector banking system and demands for a lot more regulated financial system to prevent yet another recurrence. And we can already see the political winds shifting. And then there is a geopolitical dimension to this. The most powerful intervention was the US swap lines. Who is being bailed out? It's corporates and banks in other countries. It's the banks in Germany, in Brazil, in India, in Singapore, in Japan, in South Korea. The United States is bailing out the rest of the world. So by that being so important, it signifies and strengthens the importance of the United States in the world. And that the power that brings, I think, is also underappreciated. So I suspect, and finally, if the banks, even if you don't buy any of that, if the banks are being bailed out every 10 years, they will continue on taking yet more risk. They will become ever more short-termist, because what this is telling us is you manage short-term risk, but long-term risk is owned by the government. And if the government is owning short-term risk, you just create yet more short-termist misbehavior in insurance companies, in banks, in the corporate sector, all of which is long-term destabilizing. So the more I think about your question, Lutfey, this was absolutely excellent, the more long-term risk I see arising from what happened in March. Because of how the government reacted to it.
I had a feeling you were going to go there. Okay, questions in the Q&A box. Before I do that, would any of you like to respond to anything that you've heard from any of the other panelists?
I do want to talk a little bit about respond to John on the issue about the banking sector. I do think that the big difference this time around versus the previous time is definitely that in 2008, the banking system did come out scarred, and there was a perception somehow that the banking sector was a villain. But I think that this time around, I do feel, and I'm quite personally gratified working at a banking institution, that they were not, they were definitely a part of the solution. They weren't seen as the culprits. And I'm very proud actually of the role that the banking sector has played in supporting businesses, people, communities through this crisis. And so I think what you're talking about, John, is more of the systemic risk that's building up in the financial industry. At least I hope you're not pointing specifically to the banks, because I do feel that the role that they played is very, very different from the role that was in 2008.
No, I mean, I very much appreciate your question, and I don't think at any point in time did I attribute blame. So I'm not saying anyone did anything wrong, and I really dislike this narrative that the financial system is somehow to blame for the 2008 crisis. There's a lot more factors. However, what I'm saying is two things, right? The first of all is that practices in the banking system, whether they're good or bad, they seem to require a Fed bailout every 10 years. And that's a concern regardless of how we got there. And secondly, the situation might be different in Australia or Singapore, but the banks in the United Kingdom and Europe and the United States are coming under increasing attack for refusing to support the economy. In Britain, banks refuse to open new business accounts because they are told we have to keep risk low. So the perception that the banks are supporting the European economies might exist in Asia, but it does not exist in Europe.
Okay, let's go to questions from the floor. Rahika Saikya from Singapore is asking. She's part of the banking industry. My question is, how has the pandemic impacted the trading strategies within dealing teams? Has it paved the path to new innovative ways of risk management? I think, Sneha, that's for you.
Okay, thanks, Lutfey. Hi, Rahika. So very good question. I have to say I don't know all the answers, but let me attempt. So I think that one of the things that certainly what we're looking at quite carefully is our models. Not a lot of our models were, as you know, in the past, where models were not set up for negative interest rates. And now that we've seen negative prices of commodities, that is something that we are taking into account. So we're definitely having a look at, how those models are created to ensure that they're fit for purpose. The other big thing, just at a very high level, is that, having seen the experience of 2008, which was very much, I think, focused more on the sort of off-balance sheet and OTC derivatives, and a lot of the reform was directed towards that. But I think in this time around, we've seen a lot of issues around the actual balance sheet products. So we're talking about, fixed income products, credit products, corporate bonds. And I think that activities that are related to more efficient management of counterparty and funding for these products is something that there will be some innovation in that space, and probably some regulation as well, and things like clearing and those sort of activities will come out. I think the third thing, which was interesting in this pandemic, was that the electronification of the markets have really lowered barriers for other people, non-bank players, to also join the industry, and the impact of that into the entire industry is not fully understood. And the new sort of some of the algorithms that we have, some of the more automated trading systems that we have, the impact of that on the financial markets is also something which we need to understand a little bit better, and perhaps that itself will lead to some forms of innovation. So great question, and I think the answer is probably we're working on it.
Great. Thank you. Next question, I think, is for you, John. But before I do that, let me also say to all the panelists, I will be going around in the last minute or two, asking you for one thing that you're taking into the next year that you think should be top of our mind from a risk point of view that wasn't on our radar coming into this year? So what's that one thing or one lesson that you'd like us to take with us? The question from the box, John, is there not a very fundamental difference? This is from Brendan Davies. Is there not a fundamental difference between the practitioners and John? Practitioners are trying to better interpret existing models. John, I believe, is saying the models are fundamentally wrong. What do you say to that?
Well, I have to say no to that. I do teach a couple of hundred students a year on risk management, and I'm sure that some of you have employed my students in a risk management function. I have a book called Financial Risk Forecasting. So my view is not that we should reject the models entirely. My point is that the standard practices for risk management push us to the short term. If all we care about is short term, that's perfectly fine. So long as we are cognizant of it and recognize it, to the extent we care about the long term, we should find methodologies that are suited to the long term. And standard risk models tell you nothing about the long term, zero, nada. So if you care about the risk 10 years in the future, don't rely on your data, don't rely on your statistics. You need to build on resiliency, you need heterogeneity, you need a particular infrastructure. So there are ways to deal with long-term risk, but that does not come from risk models. But if you care about the short term, that's fine.
Thank you, John. Question for Peter. Do you expect financial repression to continue?
In many parts, at least in Europe, it has to, because it's hard to see how governments could deal with higher interest rates. So I think we've put ourselves in a position that has no real exit. Something has to give. For the rest of the world, it will be interesting because will there be more of a decoupling of Europe and then it would be Europe and Japan actually, because Europe pretty much goes into a Japanese scenario. But I would expect it to continue because I wouldn't see a way out because structural reforms are not taking place. And I think that's also collateral damage of COVID. A lot of people start to believe that you can print money forever and a day and there is no consequence to it.
Right. John, someone's asking if there are metrics that you would suggest for long-term risk, or is that not the right way to frame it?
I think I answered the last question. The answer is no. There is nothing that measures 10-year risk or risk beyond that. By the way, there is a view by some people in industry and academia that you can do that because it's really easy to measure day-to-day risk and then plug in an extreme probability, an extreme outcome, and out pops a number. You can create a number that represents 10-year risk or 5-year risk or 20-year risk out of your models. But my view is that these numbers are meaningless and need other approaches to think about long-term risk.
Okay, thank you. I think we've now come to the end of our time. We've got 2 minutes left for a quick round of the panelists for their one thing. There is one question in the box asking if we can have a summary of what's been discussed. The video will be posted, unless there are technical glitches. The video should be posted on YouTube so you can get you can watch it all again. So, Grace, let me start with you, please.
So I don't want to, so you've asked about what is the one thing that will lower risk that I'm bringing into next year that I wasn't thinking about in January.
Yes.
So I don't want to succumb to availability bias. So I'm going to say hand sanitizer and a face mask.
Excellent. Thank you. Mohit, what's your lesson for us?
Not so much of a lesson, Lutfey, but the one thing that I'm looking at very closely when we go to next year is how much do things actually change and go back to normal? And in particular, I'm thinking about the work from home numbers that we have as an industry, but also more broadly as societies. It seems that it will remain sticky. Our survey seems to show that 80% plus people believe that they will not be working from the office more than 2 days a week, and that has such an impact on your infrastructure requirements, on the employer-employee relationship, on taxation, on corporate real estate, on residential real estate. So that's, I think, one thing to watch because that has long-term social and economic implications.
Right. So it is the new normal, although we don't like that phrase. Peter.
Well, I think 2021 will be the year where we need to be careful not to miss anything while celebrating potentially coming out of the COVID crisis. And I think that's the holistic perspective on our environment, I think, will be more important than ever and will be very high on my list.
Thank you. Sneha?
I think, Lutfey, for me, the big thing is that, 2020 has been a momentous year because there's been so many lessons. And for me, the big thing would be to make sure that we take away all the good lessons and throw away all the things that didn't work for us. So really sort of embrace the good things that we've learned this year and make sure that we really work hard to avoid all the things that didn't work for us.
It'll be a shame not to learn the lessons that have come our way
Exactly.
so painfully. John, you have the last word.
Sort of my take from 2020 is that both the risk managers and the regulators should stop worrying about the day-to-day risk. They should stop trusting their risk models, stop trying to model all the tiny micro risks that everybody's supposed to do, and start thinking about what really creates a crisis, what really makes banks fail. And that means thinking about the stability of banks differently, focusing much more on resilience and much less on risk management.
Much less on risk management. Okay, thank you very much. John, Peter, Grace, Mohit, Sneha, thank you so much for your time. It was a great conversation. And thank you to the audience for being with us. And with that, we bring this to a close. Thank you.
Thank you.
Thank you. Bye-bye.